Hello, everyone, and welcome back to our latest episode of Real Take Real Estate with the Joseph team, where we give you our real take on everything to do with today's housing market and real estate. I'm your host, Maddie Maloney, joined by my co-hosts,
Sam Feda,
Joe Sambear.
And today we are super excited to have a guest on our podcast, Jon Grocki. Thank you so much for joining us today.
Thank you. I'm very excited to be here.
Wow. So just a little bit about Jon. So Jon has over 2 decades of experience in the financial services industry, serving as Dart Bank's trusted investment manager. He enjoys developing personal relationships with his clients and hearing about their passions, interests, and dreams. He gains an intimate understanding of their long-term goals and develops a strategy to achieve them. Jon graduated from Central Michigan University with a BSBA degree in personal financial planning and concentration and investment theory. Jon is devoted to his community. He serves on the Mason Area Chamber of Commerce and the South Lansing Holt Rotary Club, volunteers as a guest auctioneer for the Ingham County Relay for Life, and hosts Movies by Moonlight each summer for community members. He and his wife have two daughters who are active in sports and school activities. They enjoy playing board and card games, traveling, and spending time with their dog, Tika. Thank you so much, Jon, for joining us today. We are super, super excited to have you on. You have, over 2 decades of experience kind of seeing different markets and the volatility, and we'll get into some of that definitely today. So there's 3 things that we really wanted to cover. The first one is when someone is starting their family and maybe they're just now starting to look at buying a home or in their process of it, what kind of financial goals should they be looking at, not just buying a home, but maybe all encompassing. We also want to talk about what to do, if anything, with your money during market volatility, because that is a very hot topic right now and just a lot of uncertainty. And sometimes people just go off of the clickbait media that they hear online and can create lots of anxiety. So just kind of go over that. And then also how best to use the equity in your home and how you can take advantage of that to further gain some financial freedom.
Sure.
So
all great questions.
Definitely.
Well, thanks, Jon, for coming. I think when households form, one of the big clear things from an investment side is I want to get my house. I want to purchase my first home or purchase my next home. And they go through that process. They kind of go through all the financials, pre-approval, work with us and get closed. And then I think a common question is, or something they should be considering is, what's the next thing
Sure.
to complete their overall financial picture? What are some of the things they should be considering?
Sure. So I think that purchasing their first home, it's just a huge milestone moment in your life. And so many of us, I think this is maybe kind of a U.S.-based kind of thing, but definitely part of our culture here. We get told for years and years of our lives growing up, hey, your first home, it's your biggest investment, which we've talked a little bit here already. I don't always necessarily agree with that sentiment, but your home is your sanctuary. It's a place where you go to be comfortable. It's a place where you go to be with your family and escape from all the other stresses of the rest of the world. And so making sure that you're not just viewing purchasing your home as a financial transaction, something that you're going to be flipping later on to try and make money off. I think it's so much more than that. But things that you really want to be aware of when you're purchasing the house, this is something you just learn as you go through it, of course, but the extra expenses that you're going to have when you buy a house, making sure you're taking care of the yard, making sure you're taking care of the property taxes. Property taxes we could talk forever on. Many people aren't prepared for the first time their property taxes get adjusted. And so all of these things, making sure that we're building into people's budgets a little bit of room, some comfort, some breathing room, keeping them from necessarily biting off a little bit more than they can chew when they're looking at purchasing a house. That's where probably I would imagine having people like you that are giving a lot of that same advice, as people are looking at this, making sure that this is really going to be something that they can enjoy. Making sure you're protecting your ownership, insurance, and things like that as well.
And just going off of that, we do have these conversations a lot where people are like, all right, I have $20,000 saved up. That's everything that I have, but I want to put it all into a house because I know how good it is. And we're like, all right, hold on. we do want you to eventually be a homeowner and achieve those home ownership goals, but we want you to be a successful homeowner. And that's not going bankrupt or going completely cashing out everything in order to get into this home. Because again, you have those future expenses when the property taxes change, when, you know, something happens, and there's many great things about owning a home, but those unexpected things that come up that are a little bit more pricey than maybe you would have thought. So that's why we always advocate, all right, let's see what we can help you to do to be a successful homeowner and not just have that investment like, oh, I bought a house, that's all I really need to do.
Yeah.
And that's not really the only thing. You should have a larger portfolio to really help your financial goals.
Yeah. Homeowner can be part of your identity, but if it's all you got, you're missing out on a lot of other things.
Jon, is there a particular list of a few other things that they should start considering?
Yeah, I think that anytime you're going to be incurring debt, you're going to have a mortgage, you're going to have a financial obligation there, making sure that you've got your proper life insurances in place. If you're not here, and you've got a family that's depending on you and your income to support being in this home. And if that's something that's important, that you want that family to continue to live in that home, making sure you've got some insurance in place to protect that, you know, and all of your upkeep and everything else that you do it. You know, a home can get away from you in a big hurry. And so making sure that you're just get some help figuring out, hey, these are the things, if you haven't had it before, you know, your roof, your furnace, all of these things, make sure you're keeping the updates going.
Yeah, exactly. That's a huge point with the insurance piece. I had a client that thought the loan was only in his name. And so, you know, if something happened to him, he thought his wife was all square, didn't have to make the payment, all that. So that's kind of the extra things you have to think about and bring those conversations to the table. So.
Absolutely. We always talk about when, you know, creating your best team, even when looking for a home. You know, there's the realtor, you got us, the lenders, but really to make the full financial picture, you got to get some other people in there as well to kind of guide you, especially if you are a first-time home buyer just starting your family. There's a lot that you may not know, and that's okay, and it's good because you want to be able to ask those questions and get someone to back you like Jon, who can kind of explain the next steps on some of those things. You can talk to our team about the housing, how we can make you a financial homeowner, but we also want you to be just financially stable in the future as well. There's a hot topic term about creating generational wealth as well, which homeowner is part of it, but also those other investments can be huge to save you down the line and just creating that bigger portfolio, which is definitely a huge goal that we have for our clients.
And the danger, I mean, you'll always hear people say the danger is not what you don't know, it's what you don't know you don't know.
Yes.
And that's where people get into trouble. And so don't be afraid to learn from other people.
Absolutely. There's a lot of great podcasts out there and books as well, but we always recommend talking to, you know, someone who has had 2 decades of experience in this, who went to school for this, not just listening to whatever podcast that you find. Those are great and informative, but they're not going to be tailored to your needs. You need someone that can look over your whole situation, your own debt, to kind of come up with that best plan for you.
And we're definitely the experts in our field and the real estate mortgage side of things, but we're just seeing a piece of their portfolio. So a lot of times, like Maddie said, when there's a significant down payment available and they ask, like, should we put all this in? And what you usually get back with them is like, well, do you have a financial planner? Because we're just seeing a little piece of this. So it's kind of hard to answer that question. I can give you my opinions on a few things and show you a few scenarios, what might be in your best interest. But really, if you don't have someone to walk aside with you and look at the whole overall picture, that's why we love working with financial planners and coordinating with them, because it is a coordination. It can't be just transactional. It has to be like, we need to look at the whole thing together. Otherwise, it's hard to answer some of those questions.
And so, yeah, with that kind of gearing a little bit away from the first-time buyer and all that, since, you know, the last couple of months here, there's been some market volatility. Just kind of curious, to say the least, really, kind of why everyone's worried and how it impacts different age groups. Can you speak a little bit to that?
Yeah, I mean, we could talk for a real long time
Couple
on
hours,
this, but obviously in the past month, we've had a few things kind of happen here, and certainly I'm not going to get into political weeds here, but lots of discussion about tariffs in the last month. And One of the things I tell people is I think the issue of tariffs is far too complicated to just say tariffs are good, tariffs are bad. I don't know. These are things that take years and years and years to really play out and see what worked and what didn't. But I do know that what the market will struggle with at any point in history is these periods of uncertainty where we just don't know. And I remind people, we saw this 5 years ago with COVID. COVID hit the scene February 2020, and we had a stretch of time there where markets just reacted incredibly volatilistically. I'm able to tell people this now, 5 years later.
Yeah, exactly.
But 5 years ago, I will tell you now, it's the most scared I've been in my 25-year career. I've never seen anything like that 5 years ago. And what I like to remind people is that 2020 ended up being a really good year for markets. Who'd have thunk it? But I think it's a great reminder that our markets don't need good news to go up. Our markets don't need good news to grow. We did not have a surplus of good news in 2020 that drove the markets into positive territory. What we did have was once we got past the initial shock of here's this global pandemic, here's what we're dealing with, we start learning a little bit about, okay, what are the next steps? What do we do? How do we move forward from this? And I think we have the same kind of thing happening right now. Tariffs hit the scene. We don't know what it means. And market just immediately takes 10% right off the top while we try to digest this and figure it out. Once we can get a little more knowledge, here's the nations that are involved with this, here's what it means to trade policy and tax policy and everything else, I think that will be enough for markets to start making their way forward. Doesn't mean that there's not new challenges and new struggles. Of course there will be. But I always remind people, too, companies have not lost their profit motive.
Yeah.
They're still, trust me, Apple and Google and Microsoft, they're all still interested in making money. And our system is really based on if you are an owner in these companies, as they're making money, you should share in those profits as well. And so trust that process. We do go through these difficult times. People who've worked with me for years and years have heard me say this dozens and dozens of times, but a little bit of faith and a lot of patience is what is required when you're dealing with long-term, especially retirement type of investing. And so having that faith and patience to let the system work, let it do what it needs to do. Trust me, there will be times where you're not happy. This is, people that I opened accounts for 5 years ago, and they've worked with me for this time. When this happens, it's pretty easy for us to work our way through. They've seen good, they've seen bad, and we've gotten through it. Accounts, new clients, and new accounts that I opened end of March. It's a tough putt because this is their only experience with me, and they just got started, and it's been all negative through most of April. But that's why we spend a lot of time telling people before we open accounts, before we get anything going, letting them know this will happen. There's going to be a point in time you're not happy with your account, you're not happy with me, but a little bit of faith, a lot of patience. We can get through it.
The other thing, John, sometimes it seems like a general rule of thumb for when you're making big time financial decisions is not necessarily to do that in a crisis situation.
Yep.
I mean, just generally speaking, it's good to really take that. You can make those moves, but you really should even think it out a little bit.
Well, I think especially in a case like this, where this is a man-made event. This is not something where Mother Nature came in and wiped the table clean. This is man-made policy that we're trying to decipher. What does it mean? And I think particularly with this administration, where I've made mention of this before, where they've shown that they are willing to change directions pretty quickly. For better or worse, sometimes that can make things a little hard to know where to go to. But just knowing that, hey, we're making major financial decisions based on something that an administration could turn around next week and say, nope, we're going to do it differently. You got to be careful. And I feel like right now we're at a point where there's risk being in the market and there's risk being out of the market because it can just move that quickly right now.
I remember you said in one of your emails about when looking at your accounts during this market volatility, what you got to go back and think of your goals. Are you trying to get rich right now, or is this for your retirement in many years down the road? And that is where you really need to understand your future financial plan and how it is a long-term investment. You're not trying to get the most out of it every single day, every single time the market changes, but you just got to continue to keep your eyes on your goals and your long-term investments. And again, just have that patience that it will come back eventually. It doesn't look great right now, but everything's going to have a roller coaster. It can't continue to always be better, always be improving. There's going to be ups and downs, and you got to expect that and just know and trust your financial advisors that there is going to be a plan, and down the road everything should be good. But just having that team to back you up and letting you know, based on your situation, based on your age group, based on what you currently have invested, here's what we think that you should do. And most of the time, if it would be right now, just keep the money in there. Don't take it out right now. Do you have any more comments on that?
Yeah, I think when we go through a stretch like we did earlier this month, there's this immediate visceral reaction that, oh my gosh, I've got to fix this right now. I've got to do something right now. And I think this is part of society has kind of moved into this instant gratification culture that we have. And young people get picked on this for this a lot, but I think it really is all of us. We've gotten to a place where if we want something, I hop on my phone and DoorDash has got it at the house in 20 minutes. We are not accustomed to having to have patience. And so when we go through these moments, taking that breather and really focusing on, this is something I do with a lot of clients, focusing on what is the objective here? What are we working towards? And I think what I wrote in that email you're talking about was, was our goal a retirement in the future filled with security and the ability to enjoy yourself and do all the things that are important to you? Or was it to be able to look at a statement on April 8th, 2025 and say, there it is, I made it? And universally, the answer to that, I think, is that we are looking much farther out than just today. And so we'll go through these. They'll happen. And that's, I'll never stop telling people these are things that are going to happen. The more we can be prepared for it, the easier it will be.
So next question that we had, kind of going back to a little bit more mortgage related, home ownership related, but we have some people right now, especially now when they have a really good rate and they're probably not going to want to move, but they have lots of equity in their home. They're not really looking to use it right now to purchase a new property because they're comfortable, they got a good rate, but they have equity. What are some ways that they can use this equity to their advantage?
Sure. And so, when we're talking about, make sure I understand what we're really looking for here, but what people who have mortgage balances and they're sitting on their 2% and 3% interest rates right now, and they're looking at scenarios where, boy, do I continue to carry this loan? What do we do with it? I think that what I always remind people when you have a mortgage loan like that, really what you're talking about is you're purchasing flexibility. That's what any loan does. You're purchasing flexibility. Instead of having to come up with $400,000, $500,000, $600,000 for a home and all the ramifications that would go with that. Boy, how do we raise that kind of cash? We can have this flexibility where the loan provides that for us. And now we have the decision, boy, do we want to pay that all off or do we want to continue to have all the flexibility that we have? And I always remind people, and it's a real common scenario with, there's a few things where we'll see it, but surviving spouses is probably the biggest one where we see a situation where loss of a spouse, insurance payments come in, and the initial reaction is get rid of all the debt, pay off the house, pay off everything that's there. We want to just wipe the slate clean and have that. And I understand that emotional reaction to that. But I always remind people, listen, if you have $200,000 in life insurance, that can do a lot of things for you. It can buy groceries, it can pay the light bill, it can send the kids to camp, it can pay tuition, it can do all of these things. Once you pay off that mortgage, you lose all of that flexibility. You give all that money back to the bank, and now if you want flexibility, you got to go back to the bank and you got to say, hey, turns out I actually need some of that back. And guess what? The bank will be happy to do it, and they're going to charge you for it. And so making sure that you maintain that flexibility. There's an expense to it. Right now, this is an easy math problem. If you got a mortgage where you're paying less than 3%, you should not have any concerns about continuing to make those payments. I don't believe that you should, in most cases, be looking for a plan where you have to accelerate paying down that mortgage. It's very easy right now to go out there in April of 2025, I'll put a date on this, to go out there and earn 4% or better without having to take a whole lot of risk on cash. And so it's a real easy math problem where you're paying out 2.5 and earning 4 back on the other side. People can understand that. But as rates change, that's where you guys are going to be really helpful to people as well, letting them know, hey, here's what it looks like if we did have to refinance, if we did need to pull equity out. Here's what the payments look like. Here's how it affects your finances, and working in conjunction with somebody like me, people like you, I think we can do a lot of good for people too.
Absolutely. And I think that part of this is going to get into another episode that we will have coming out later about good debt versus bad debt. But one thing with the home, people do just kind of have the mindset like, oh, I don't want any debt. Everything needs to be gone. Well, let's look at that a little bit more. If you do have a 2.5% interest rate, you can really keep that, and let's focus on investing. Focus on paying off some of the higher credit card bills. Focus on some other things rather than just trying to have that goal of being debt free that may not actually be the most beneficial to you in the future. And it seems wrong that, what do you mean I should keep debt? Wouldn't you, when I want to pay it off? But it's just knowing the market, knowing what you can do with your money as well. And that's where the financial planner comes in to kind of help guide you like, all right, let's not be this aggressive on this. This is great to have right now. You can keep the lower payment, but let's tackle some of this other stuff. Let's see what other future goals we have to make sure that we can plan for those and have funds set aside instead of just paying off this 2.5% interest rate.
One thing I found that sometimes works for folks is the idea of working backwards on this too, where sometimes the idea of, oh my gosh, I've got this 30-year mortgage or 15-year mortgage, whatever it is, and people really get overwhelmed with the idea of having to carry that debt for so long. And I will say, okay, well, what's a date that you like? Let's look at this. And to that end, if we can say, here's a date that's important that we'd like to be done with debt by this point, I will work with people. I don't think we want to be overly aggressive, especially with low rate debt, but trying to figure out, hey, if you wanted to be done with this mortgage in 23 years instead of 30, okay, here's what we can do. We can work backwards on this. And I also think that helps people focus on what's the more important part, because it's not necessarily being debt free. It's being debt free at a particular moment in your life when you need to be or don't, as the case may be.
Yeah, because a lot of people want a rule of thumb or just a general rule about this, and it's hard to give that answer because we've had several customers that they're going to live on their pension only. Well, that's 18 years out. Well, yeah, we maybe want to retire that debt in 18 years. Where we have other people that just pay it aggressively they really didn't have a plan why they're doing that, and now they have this huge asset for the next 20 years that they can't touch. Yeah, essentially, and it also has to come into your long-term plan for your estate as well, and thinking about what are you going to do with that investment.
Just being debt free is a admirable goal to be, but it's not a plan. You can have a plan for what does being debt free mean. What will I do with that? What will I do with all that flexibility that I have? And so, just building that plan.
So when people, let's say that someone has a bunch of equity in their home, they they still have a mortgage on it, but they also have some other debts as well. And they're looking to see, all right, so I have this equity, and I also have, maybe they came into an inheritance. Should they maybe look at paying off that mortgage, or what should their thought process be when looking at trying to pay off debt? What should be the first one? And is there kind of like a strategy when it comes to paying off debt?
Yeah, there's lots of different methods people will use when you're dealing with debt management. Typically, first things first, making sure you're caught up on everything, making sure nothing's you're not getting behind on anything. One of the more common strategies, a lot of times people will try to focus on the interest rate part of it. Here's my high rate debt, here's my low rate debt. Mathematically speaking, yes, focusing on the high rate debt is something that makes sense. But there's also a cash flow component to this too. People have their income that's coming in, and making sure that we're taking a look at what are the individual payments for each debt that you have. You've got your credit cards, you've got your auto loans, you've got your mortgage payments, things like that. Typically what you'll find is that just throwing some extra money at the mortgage payment is not going to help your cash flow, in the sense that you're not going to pay that mortgage off in the next 18 months. And so you're kind of locking yourself into this plan where, I guess this is what I'm doing for the next 22 years. If you have a $1,500 credit card bill or something like that, though, that you're trying to get rid of, well, now here's a short-term objective. I think there's also kind of a dopamine effect with this, where you can make your brain feel good getting rid of something, getting something off of your plate. Boy, I had 4 credit cards, and each of them had I had $600 on this one and $3,000 on that one. Getting rid of that $600 credit card, one less payment you got to look at. People are probably familiar with, they'll call it snowball elimination of the debt. It's nothing new. I'm not inventing this. So, but yes, getting rid of, there's an emotional component to getting rid of those smaller amounts of debt first, which allows you then to roll that payment into the next one and go from there. And so I think that can be a really valuable way to approach this. I don't like to completely rule out the idea of if you've got 23% credit card debt and you've got a balance there versus, sometimes you'll see like a medical debt or something that's at very low interest a lot of the time. Okay, we've got a little bit of flexibility on the medical debt. Let's focus on the credit cards, things like that.
So it sounds like when you're looking at paying off debt, it's not, I feel like some people kind of think, all right, I got to go from the largest debt down to the smallest, so try to get rid of the bigger one. That's not really the case. We really should be looking at, all right, what one has the highest interest rate that I'm losing money on for this one, and kind of build down from there.
Yeah, I think it's a combination of looking at the highest rate, but also the ones that are going to be the easiest to get rid of.
And the cash flow, because sometimes smaller loans might have a bigger payment for whatever reason or something, so that can be helpful.
And so
I think one thing that you bring up, Maddie, about paying off debt with a mortgage, and I've seen this over my career, is sometimes it's really opened up cash flow for people and really put them in a really good long-term position. But I think it goes back to what's really happening, because you do have to be careful of paying off $50,000 worth of credit cards. Are we going to be back in this position a couple of years later? So I think you can do one, but you have to make sure you have a plan for what's the next step? Because
Joe, hearing you say this is making my heart so happy right now, because this is not something you normally expect to hear from the guy who's loaning the money out.
Right.
They just want to push the money out the door. But I've had these conversations with people where, whatever windfall they come through, they say, hey, I've got $20,000, and I just so happens I also have $20,000 of credit card debt, and I'm going to pay that off. And there is a component to this where if people are not used to doing the hard work, the heavy lifting, paying that debt off sometimes puts them in a headspace where, guess what, we come back in 2 years and it's all back.
Oh, yeah.
And so there is an element to this where sometimes, hey, there's the number side of it where I can say, yeah, mathematically, yes, take that $20,000, pay off the credit card debt. That's a mathematically sound decision. But there's a part of this too, which is how will your behavior change through this as well? Something happened for you to build up that credit card debt in the first place. Have we addressed that? Because if we lose this $20,000 and we're back here in the same place 2 years ago, I don't feel that I really helped you. It doesn't make me feel good about the relationship that I have with that particular client. And so trying to address those issues, make sure that sometimes that means, we spend a little bit more on interest payments while we build up good habits. And it's hard to tell people that, because we're all kind of hardwired to look at the numbers, the dollars and cents part of it. But that long-term perspective on where we're trying to actually get people, I think is just so critical.
Yeah, that's a great approach, because you have identifying the root problem, because, we've seen that before where you can just be right back to square one, like you have the instant gratification that people want. You pay it off, it's done, but then the root problem's still lingering out there.
Yeah, it's the same thing. So.
All right, so one of my last questions, what would you say the best advice that you have for someone who is just starting their family or buying a home? What is the best advice that you could give to them to start looking at in that time?
Okay. So we're talking about maybe like a younger person, younger family.
Yep.
Okay. The basics of, to me, there's a progression here that we look at when we're trying to figure out, hey, here's the income that's coming in. How are we going to allocate this, take care of everything? And certainly your home, and making sure that we've got all those pieces in place for you to be comfortable with your mortgage payment, comfortable with your tax payment, comfortable with the insurance payment, all these different things. But when we're talking about how do we allocate that income to make sure we're making smart decisions, I'd say here's the progression I follow with almost 100% of the clients that we see. The first place you should be looking to save money most likely is going to be in your company-sponsored retirement plan. For most people, that's 401ks. If you work for the government, it might be 457 or 403b, any of those. They got a 4 in them a lot of the time. Start using those plans. Figure out how those plans work. Companies spend tremendous amounts of time, money, and energy putting these plans in place. And then often it breaks my heart to see that there's no education piece that goes with it. And so to me, it's a terrible tragedy when somebody says, yeah, I've worked here for 25 years and they've got a 401k plan, but I never used it. Meanwhile, the company, in many cases, will pay you to use that plan. So capture that match money in a lot of cases that you get from your employer. That is the first place that we want to look. From there, we start looking at your individual retirement account options. You've got IRA accounts that you can use. You can set up your own retirement funding. All of this, of course, in conjunction with your budget that you're managing, making sure that you're keeping everything in control there. From there, if we still have discretionary income where we say, hey, we want to continue doing more savings. Now we start getting a little more specialized where we're talking about what is the extra savings for? Are we talking about savings for the kids, for education, for other expenses that come with kids? There's lots and lots of them. And so we can start putting those individual plans in place for those. Or we just have short-term needs that we need. Hey, we're going to we're going to be looking at a bigger house in 10 years. And so we want to have some funds available for that. Or we need a new vehicle in 3 years, making sure we're preparing for that. And so finding the accounts that we need for that. And so I'm not sure if that's exactly the question you were asking.
No,
but
that's great.
Just trying to build the steps that we go through with almost everybody that comes in. Because this is, in a lot of respects, can be universal for a lot of people.
So for some of those first-time home buyers or people starting their family, you said with the company, they can invest in their 401k. So should they just talk with their company's investor, or like how should they be building out their team at this point? Should they be having a couple of the other people? They'll have the mortgage side team, their advisors for that, but what should their other team look like?
Yeah. So in my experience, it's going to be pretty rare that your company has anything other than an HR person that tell you some of the basics about the plan. Here's how it comes out of your payroll. Here's, but as far as giving investment advice, here's how you should allocate the funds and things like that. It's rare that you're going to get that assistance through your employer. So I'm probably a little biased in this respect, but having a trusted advisor that you can go to, that you can come to and say, hey, John, I changed jobs. I've got a new 401k plan. I don't know what I'm doing with it. Can you take a look and help me figure out what to do with this? Certainly getting all that information from your HR department ahead of time. They've usually got documentation, brochures, and all sorts of stuff. Bring that in, work with an advisor on it. That advisor should also have an idea of what are your goals? What are you really working towards? Just like we talked before, hey, is your goal to have a giant balance on April 7th of 2025, or is it to look at retirement in 25 years? But your advisor should know the answers to those once they've had a chance to work with you and get to know you. And it should be a comfortable relationship. This should be something that you can go in and really feel comfortable sharing. And I think also in some cases being a little vulnerable with too, where if something's not going well, if you're worried about your job, if you're worried about falling behind on something, if you're worried about what your cash flow looks like, having a trusted advisor that you can have those discussions with, to me, it's just such a critical component and healthy for people to have.
Just another player on the team that everyone should have for their future financial goals and to be successful and be a successful homeowner. So just another great aspect of how we really want to help people not only just get into the house, but really be successful throughout their life and setting them up for that. Any last comments, Joe, Sam? Any other questions?
Just the last thing I would say is like automate. I think we've all see that if you don't have a place for those dollars will find a place for themselves.
Yeah,
and the more you can automate, when like even just making your mortgage payment, we see higher success when people have auto, payment. Yep. Same thing with your investments. I think some people don't think about, there's 401k, but you can also direct those dollars once you have a plan.
We are much more like goldfish than we like to admit a lot of times, in the sense that, you've heard that before. Goldfish will grow to the size of its bowl.
Yeah.
And we do the same thing with our incomes. You get a raise, you start making some extra money. Guess what? If you don't plan for it, you look back 2 years later and you say, geez, where does all that extra money going? We will adapt and we will spend what comes in, most of us anyway. So.
Yeah.
Awesome. Well, thank you so much for joining us today. We hope to see everyone next time on Real Take Real Estate. If you like this episode, please like, comment, share your feedback with us. We would love to hear it, but we will catch you next time. Thank you.